Banks could face a 20% boost to capital requirements, a change regulators are likely to propose as early as this month. Plans expected to be the first of multiple new rules aimed at improving the resilience of the banking system in the wake of several mid-sized bank failures earlier this year. And joining us now, Scott Siefers, Managing Director, Senior Research Analyst at Piper Sandler. Scott, are you comfortable with what we know to try and make predictions or forecasts about what it would mean? Because we have basically the overall outline, but there could be significant issues in the details of how this happens, how long it takes to get there, et cetera. You feel comfortable like discussing it?
Yeah, I mean, certainly discussing it, making definitive conclusions, that's another issue entirely. So, we've just got a bunch of lingering issues in the aftermath of what happened in March and April with those few really kind of shocking failures and capital requirements and higher capital levels. That's one of many issues we've got to resolve. So as you suggested, Joe, media reports are suggesting banks could be required to hold up to 20% additional capital on average. We're really going to have to get a lot of clarity as to what that means, big versus small banks. It seems that this is going to affect everybody over $100 billion in assets in some form or another. So even the largest banks have really contributed nothing negative to this crisis. And in fact, they were, largely, especially JP Morgan, were sort of saviors in the crisis. It's a little bit of a head scratcher as to why we need more capital at that level, but it doesn't seem that anybody's going to be spared. The issue will be sort of time to comply. It seems very likely that the industry is going to have several years to reach these new higher requirements. And I think they can probably get there with some time to spare, just in terms of being able to generate capital internally through earnings, probably, more diligent kind of management of their capital, meaning no repurchase or limited repurchase, probably not much with dividends, and then probably less loan growth as well. So they'll get there, but it'll have profitability and growth ramifications for some time.
I don't know how many people, Scott, and you've heard ever since the financial crisis, you look at all the different things that go into the bank regulation since then, and sort of the laissez-faire or almost the libertarian viewpoint was it's very simple, raise capital requirements. That's all you need. You don't need any of this other stuff. So that's always been the go-to. So I understand how if you really want a fortress balance sheet and you don't want anything like that to happen again, you don't have to worry about all that other stuff if you raise capital requirements. But you just said it, loan growth. We already have heard that the Fed doesn't need to go at least 100 basis points has been done for it by the credit contraction from what we've seen. So if you this would cause you wouldn't see nearly as much open loans to people, small businesses, et cetera. I mean, it'd be going into capital requirements, wouldn't it?
Yeah, no, it sure seems that way. So capital and liquidity are now very, very precious, and banks are going to be a lot more judicious with how they allocate those resources. So for the time being, as we sort of all learn these rules of the road, it's going to mean that we're less aggressive in extending credit. Now, hopefully there's enough room for banks both to continue to extend credit, at least to some degree, and raise their own capital. And there's of course a pretty robust private market that could extend credit as well. But I think the broad reality is we're going to see some limitation on credit extension vis-a-vis what we would have had otherwise.
But what would your 5-year growth rate for banks would go to? You'd have to pare that back.
Undoubtedly, and we'd be sort of throwing out numbers. Maybe it's 20% haircut. Who knows? It's some fraction of what we would have had in the past. So I guess the good news is if you look historically, banks have done a nice job managing through regulatory changes over a period of many decades. But that doesn't mean there aren't going to be fits and starts and pain along the way.
We had it doesn't apply directly to what we were going to talk about, but even banks at this point are watching commercial property. And we were talking about something happening in San Francisco. That's a unique situation. But in general, I mean, they're carrying things that probably it wouldn't help if these things got marked to market. So what are they going to do? They're going to exit commercial property somehow?
Yeah, I don't know that I'd say complete exit, but certainly a de-emphasis, right? So I think the way that this will play out for the banks is this is going to be a multi-year slow burn. Thankfully, banks don't really have to mark these types of assets to market on a daily basis. But as leases come up for renewal, we're either going to have to require clients to put in more equity, or banks might just pare back that as an area of risk. You've got some really very reputable and highly respected banks that have said that commercial real estate, specifically the office space, it's just not worth the headline risk of showing a lot of growth there, even if spreads have really widened out. So that's just going to be a pressure point for up to a few years is the broad reality.